We are going to continue our discussion on how business activities affect the accounting equation by looking at how transactions change owner's equity in the accounting equation. There are three different types of transactions that affect the owner's equity account or the capital account in the accounting equation. First, there are revenues or sales transactions. Then there are expense transactions. The difference between revenues and expenses equals either a profit or a loss for that business. And then the third type of transaction that affects the accounting equation's equity section or equity accounts are withdrawals. So now let's look at each different type of account that affects the owner's equity individually. First, we have revenues. Revenues are an increase in the owner's equity resulting from the operations of the business. There are two basic types of transactions that affect revenues or sales. These are when we sell something for cash. So when the business sells something for cash, it's considered an increase in the revenues account. And then the second type is when we sell something on account. These are sales transactions that are charged to clients' accounts, and the cash will be received at a later date. So when we sell something on account, we have a sale, and then we create what we call an accounts receivable because we're going to expect to receive that cash at a later point in time. This relates to the accounting concept of the realization of revenues, in that revenue is always recognized and recorded at the time the sale is actually made. It doesn't matter if the cash is received at that time or at a later date. Any actual sale will result in a revenue increase in owner's equity and an increase in an asset, whether that asset is either cash or accounts receivable. Revenue transaction examples are, if we look at transaction number 6, on August 12th, we received cash from sales for $295. In this particular transaction, we know if we look at and analyze what are the two accounts that are affected, we know that we received cash. Whenever we receive cash, that's a positive impact on the accounting equation. And in this particular case, we also know that we've received it from a sale. So we're going to record that as a positive impact as well to the owner's capital account in owner's equity with a $295 increase. And in parentheses, we note or write revenue. The second type of revenue transaction is when we sold services on account. So in this example, transaction number 7 on August 12, we sold services on account to Oakdale School for $350. Again, first thing we're going to ask ourselves, what are the two accounts that are affected? In this case, we know we sold services. So anytime we hear the word sold, we know that a revenue account is going to be affected. So we'll write plus $350 in the capital account for revenues. Then, how did we sell that? Did we sell it for cash or did we sell it on account? In this case, we know that the second account that was affected was an account receivable because we sold it on account. We didn't receive the cash yet. Oakdale School owes us $350, so we're going to put a positive on the account receivable side. So it's going to be plus $350 and plus $3 for account receivable and plus $350 for owner's capital account in the owner's equity section. Now, let's look at how expenses affect the owner's equity account. Expenses are a decrease in his owner's equity resulting from the operations of the business. So examples of expenses are telephone bills, utility bills, advertising, payroll, taxes, maintenance. All of those are examples of expenses that a business might incur. Expenses decrease the owner's equity account and also result in a decrease in the assets. Expense transactions look like these. First, we look at transaction number 8 on August 12th, where the business paid cash for rent. If we ask ourselves, what are the two types of accounts that are affected here? We know that the cash account is affected, and then rent, which is an expense account. We look at that and we say, that's going to affect the owner's equity. So when we look at that, we see that paid cash always means to us that our cash is going to decrease. So in this case, it's going to decrease by $300. And our expenses then are going to cause our owner's capital account to decrease by $300. Our next transaction, paid cash for telephone bill. Again, we know we've got two accounts that are affected, and we know that our cash account is one of them, and then the other one is going to be the telephone bill. So paid cash for telephone bill will result in a $40 decrease in our cash and a $40 expense, resulting in a decrease in our owner's capital account of $40. If we total the left side of our accounting equation, we see that the total comes to $55.05, and then we total the right side, again that comes to $55.05, and our accounting equation stays in balance. The next type of transaction that changes the owner's capital account is when the owner withdraws assets, typically cash, but they can be other assets, that the owner takes out of the business for personal use. This is called a withdrawal. This also results in a decrease in the owner's equity, or the value of the owner, the value the owner has in the business, as well as a decrease in assets. Withdrawals are considered not a normal function or operation of the business. Therefore, they are not considered an expense, and they must be recorded separately. If we look at the transaction for transaction number 11 on August 18th, where we see paid cash to the owner for personal use, $125. We think about it and we say, what are the two accounts that are affected? The first one is going to be, we know that the cash account is affected because the statement or the transaction says paid cash. And then who do we pay it to? We see that we've paid it to the owner. So we know it's going to decrease our owner's capital account, and it's going to result in it being a withdrawal from the owner, by the owner from the business. So we decrease our cash by $125, and then we jump over to the other side of the accounting equation and we decrease our capital account by $125 by withdrawing it, and we know that this is a withdrawal. Other cash types of transactions are when we receive cash on account, pardon me, cash on account. This is when a business collects on a cash sale, so that sales transaction that was previously made on an account, we need to collect that and convert that account receivable from an account receivable to cash. At the time that we collect the cash, this transaction does not affect the owner's equity. It affected the owner's equity when the actual sale took place, when we sold the item on account. That's when it affected owner's equity. So when we receive cash on account, it is not a revenue transaction. it does result in an increase in cash, but it does result in a decrease in accounts receivable. And this transaction looks like transaction number 10. On August 18th, received cash on account from Oakdale School for $200. When we analyze this transaction, we say to ourselves, what are the two accounts that are affected? Whenever we see the word cash, we know that the cash account is affected. So in this case, we received cash. So if we received cash, we know we've got a positive impact on our cash account. So we know our positive impact is going to increase our cash account by $200. And then we received it from Oakdale on account. So that means that Oakdale had owed us $350, then we received $200, and now it reduces what they owe us by that $200, so they now only owe us $150. And that concludes the notes for Chapter 1. And this is a list of all of the terms for Chapter 1. Please familiarize yourself with all of these terms to ensure you have a complete understanding of the chapter material. Thank you.